Hello and welcome back to Co-founder Chats. This week we're going to be talking again about funds, but this time with the company lens. To kick things right off, Alex, why do companies choose to set up a fund?
A fund really allows you to group investments from a number of people and then have one essentially company or group of individuals actually manage that collection of dollars. And so essentially as an investor, you get the benefit of being in a larger number of investments. So you get to diversify across multiple investment options. And then from the management perspective, it gives them greater access to capital so they can allocate accordingly and it can be a little bit more efficient. Also, from the individual's perspective, if you were to make 5 or 10 investments, that's a lot of time and effort to review and analyze all of those investments. And so it allows you to hire essentially a professional to do a lot of that one-time due diligence when you're actually making the investment, but also the ongoing management of whatever that underlying asset might be.
Perfect. And I'm sure a burning question for many people, what does it cost to set up a fund?
Right. So from the perspective of sort of getting structured, as we know, most funds are set up as limited partnership agreements. And so you're going to have a general partner who's the individual or group actually managing the money. And then you're going to have the limited partners, which are the investors kind of putting their money into that fund. The limited partners don't have any control over the fund or what happens with the money or anything like that. The fund is fully controlled by the general partners. The liability, the risk also for anyone participating in the fund as a limited partner is limited just to the dollars that you put in. So if you made a $10,000 investment, the most you could lose is that $10,000. The general partner, on the other hand, has the liability. They have responsibility for everything that the fund does. And so unlike with a corporation where the liability is limited to the corporation itself, if something were to go wrong and the fund would owe a bunch of money to someone, the general partner would be responsible for all of that amount. And so for that reason, most general partners are not set up as individuals because somebody doesn't want to have their house taken, their personal house or their personal car if something goes wrong in a business context. And so what they actually do is create a numbered company or some other corporation to be the general partner. So when you're looking at actually setting up a fund, your first cost is going to be actually incorporating that numbered company to be the general partner. Once you've got your numbered company to be the general partner that you're the owner of or is somewhere as a subsidiary of one of your other companies, you have that numbered company set up. The next thing to do is actually start preparing your limited partnership agreement. So this is going to be the legal agreement between the general partner and all the limited partners and is going to govern what the fund can or cannot do. So you have to spend the money on sort of setting this up. Once that's actually written and prepared, then you can actually have the general partner and the first limited partner sign the agreement and then use that with a filing to actually register the limited partnership and actually create the limited partnership, the declaration of limited partnership. So those are just sort of creating those entities from a legal perspective. Now, you'll probably have some other costs associated with running the fund. Like if you're going to have anyone come and invest into your fund beyond yourself and the first limited partner, you're probably going to have to pay for a subscription agreement, which is the actual agreement that investors sign subscribing or purchasing those limited partnership units, the pieces of ownership in the fund. You're probably also going to be paying or getting some sort of reporting support so you can provide information back to those limited partners on an annual basis. You're going to be paying probably for a term sheet or some sort of document that summarizes what your fund is going to do, what you're investing in, and what potential investors could get out of it. So you're sort of paying for all these legal documents. And then on an ongoing basis, you're going to have to pay for some accounting and legal fees supporting the fund on an annual basis beyond, your own salary and any costs associated with actually managing those investments. On an annual basis, you're going to need to be preparing the tax filings for your numbered general partner. And then if you're doing internally prepared financials or whatever, you'll either prepare those yourself or you're hiring an accounting firm to prepare those. And then for the limited partnership, there's a whole number of different filings that you're doing, including preparing some tax documents called T5013s, which are individual tax forms for each limited partner. And so you'll either work with an accounting firm or you'll have an in-house accountant or bookkeeper that will sort of help you prepare all of these annual tax documents. So those are just some of the baseline costs and items you'll have to think about. Now, a lot of these costs are during the setup and their legal costs. And so depending on the lawyer that you're working with and what they charge hourly, what these could cost could vary quite broadly.
All right, thank you, Alex. How do I set up a fund and what are the components that I need?
Right. So at a baseline, very simple fund, it's going to be typically a limited partnership structure. So for a limited partnership, you need a general partner and limited partners. The investors are the limited partners. You're the general partner. Now, you personally shouldn't be the general partner. You should create a numbered company or some other named corporation whose only purpose is to be the general partner of this fund. So you're going to have a numbered company that you've incorporated, and you're going to have your limited partnership, the declaration of limited partnership to actually create the fund, and then you're going to have the limited partnership agreement that governs everything that takes place. That's the baseline of what you need to actually create a fund.
Perfect. And you mentioned all these components. What's the sort of timeline I should expect to spin something up like this?
If all you're looking to do is set up a simple fund with a numbered company and it's just a limited partnership, you could probably do that in a week or less, depending on how available your legal counsel is. In terms of going further and actually starting to make it available for eligible investors by creating an offering memorandum and doing an audit and things like that, that's going to add multiple months to your timeline of getting that launched, because the offering memorandum is going to take some time and the audit will take some time. So if you add on those pieces, sometimes it can take 2 to 3 months for an offering memorandum. Sometimes it can take 7. It really depends on what your fund is doing, how available your law firm is, and how much time they're willing to dedicate towards getting this done quickly for you.
And that's on the setup side. So how long do funds typically last in terms of when they're raising or even the life cycle of a fund?
Right. So there's basically two general different methodologies when it comes to setting up a fund. You're either going to be choosing to have basically a very long-term fund, almost like an evergreen fund. So the fund's going to stay existing and operating for like 100 years, or you're going to have a fixed term fund. If we use real estate as an example, a fixed term fund would be like a development fund. So you're investing money into the fund. The fund is then going to go out and invest in a bunch of different development opportunities that are turning kind of like bare land into houses, or they're turning like an old building into a condo or something like that. And the idea with the development fund is you put all your money in, they take the money, they work on all these properties and turn them into the condo building that takes 5 years. So you're not getting any money for 5 years. But when the condo building is done, then the condo building is sold off to people wanting to buy condos. And then you get a nice big payment at the end. And then the fund is shut down and closed. From a venture capital perspective, most venture capital funds are quite similar. So you put the money in, they take it, they invest in a bunch of different startups. Those startups grow. Hopefully the startups either IPO or get bought by someone else, and there's an exit for the fund. And then all the money comes back in sort of a big lump payment and goes back to the investors. Now, the other type of fund, the Evergreen Fund, I'm going to use the real estate example again. This would be sort of you're buying an existing property. So you're buying an apartment building, and then you're going to rent out and operate that apartment building. And then the apartment building is going to generate returns from people paying their rent. And then a portion of that rent after expenses will be paid out to the investors as an annual distribution. So some of the capital is there, it's being distributed to you either as a dividend or an interest payment or something like that. So in this scenario, what I sort of described is basically a REIT or a real estate investment trust. And so in that scenario, the fund is going to last for a very, very long time because they're going to hold and continue to rent out these buildings. And the way you get your money out is not waiting the 5 years like the development fund. It's essentially choosing the moment when you want to leave and then doing a redemption. So a redemption is basically when you take your units, the ownership you have in the fund, you take it back to the fund and you say, hey, I'm all done. I want to have my money back out. Now, most private funds will have some sort of redemption cost or penalties if you redeem too soon. So usually that's somewhere between 3 and 5 years. There are redemption fees of some sort. So with any private fund investment, you should always be expecting your money to be in the fund for probably at least 5 years, just to be safe. But you put the money in, you go about your life, it's continuing to generate you some returns. And then at the end of the 5 years, you could come back and say, okay, I would like to exit my position, please. I'd like to redeem my units. And then that's how you would get the money back out. So those are sort of the two different examples. You've got this sort of set term, shorter 5 year period, and then you have longer kind of evergreen where you have to choose when you want to take your money out.
Perfect. And you alluded to this, but how do I make my fund TFSA and RRSP eligible? Like, what is a trust company and what are the sort of associated costs?
Yeah, so making your fund TFSA RRSP eligible, if your fund is set up as a limited partnership, you can't simply make the limited partnership able to take in registered funds. So the first thing you have to do is essentially set up a trust company. So the trust company kind of goes on top. So the investors would invest into the trust company, the trust, not a trust company, a trust, and then the trust would invest into the limited partnership. So that's the kind of core structure you need to have in order to take investors via registered funds. Now, in order to take those investors, you're probably also going to be using a different prospectus exemption. So most funds are typically, when they're just a limited partnership, they're using the accredited investor only exemption, which has less reporting requirements and less paperwork involved. But if you want to allow in a broader range of investors and you're setting up a trust, you might also use a different exemption called the offering memorandum exemption. And so you're going to have to prepare the offering memorandum itself. This also comes with ongoing annual audited financial statement requirements and annual reporting to the regulators. Now that you have the pieces in place to actually accept registered fund investors, this doesn't mean that anyone with their RRSP from TD Bank can just come and invest in you. You actually have to find a trust company. Now, this is different than the trust being the trust legal entity that you've created. A trust company is a corporation or a business that specializes in managing funds in trust for other people. So you'd need to find a trust company that's going to be willing to work with your private fund and help confirm that that's TFSA RRSP eligible and manage basically the TFSA RRSP accounts on behalf of the investors. So there's a number of different trust companies that do this in Canada. A few of the companies that do this would be Olympia Trust, Western Pacific Trust, and Odyssey Trust. Those are three examples that do this in Canada. So you, as the fund, you'd create the trust, you'd get your offering memorandum prepared, you'd get your audit prepared, and then you would go to one of these companies and pay a fee, and they would review your documentation and sort of verify that you're eligible to take investors through TFSA RRSP. Now, you'd also need to work with an exempt market dealer like Equivesto to actually allow those trades themselves. So the trust company is making sure that the investments are being held inside the TFSA RRSP, but the exempt market dealer, our responsibility is to actually do due diligence on your fund, make sure that investors understand the risks involved in the fund, but then also make sure that the investor coming in is suitable and actually eligible to invest in the fund based on the securities rules. So you're creating your offering memorandum to allow eligible investors in, but the exempt market dealer is determining who is eligible and who is not, and what amount would we recommend that person invest into your fund. So it's kind of a dance of three different groups. It's your fund itself, it's the exempt market dealer, and it's the trust company, all sort of working together to help investors participate.
Perfect. And for a company, what kind of costs should I expect to pay for these services? I guess with all three companies.
Yeah, so if I'm looking to set up my fund in a very simple way, paying for the actual creation of the numbered company to be the general partner, paying for the declaration of trust, and paying for my limited partnership agreement, that would be a few $1,000s, probably sort of $5,000 or $6,000, maybe slightly more if you're creating a custom limited partnership agreement. That's the baseline piece. Now, if you want to sort of go above that and actually set up the trust and the offering memorandum. Now, setting up the trust and the declaration of trust is going to be another few $1,000s. Then you're going to actually prepare the offering memorandum itself. This, can range from $50,000 to $70,000 to prepare an offering memorandum. Can be quite expensive with the securities lawyers. And then you're also going to have to do an audit. So the audit might be, $5,000, $10,000 to the accountants to do that audit. Once that's set up, then you're going to be actually going and setting up with an exempt market dealer. So Equivesto has an upfront due diligence fee of $5,000 Canadian, but other EMDs will have other fees. Some of them are much higher. So make sure you understand which EMD you want to work with and what those fees are. Most EMDs will also have a success fee for all the investments that they work on. So confirm what those fees are. And then you're going to have to go and work with, the trust company to actually verify that you're, TFSA RRSP eligible. So that's typically around $1,000 as well. And then don't forget the investors themselves will have account fees and transaction fees from the trust company. Most exempt market dealers do not charge fees to the investors. And then you will probably have internal costs associated with managing the fund. You're paying people internally to assist with the documentation and paperwork. Every time you do a closing, you're also going to be paying your legal counsel to help prepare that closing. And then there's going to be a small couple $100 fee to the regulator for filing that closing, that report of exempt distribution. So the fees can really start to add up.
Perfect. What type of investors can invest in my fund?
That's a great question. So if you're setting up a basic fund that's just a limited partnership, then you're essentially limited to accredited investors only and family, friends, and close business associates. So accredited investors are individuals with 200,000 in annual income, 300,000 combined with a spouse, or $1 million in net financial assets, excluding real estate, or $5 million in total net worth, which could include real estate. Individuals that sort of meet those qualifications would be accredited investors, and you're limited to them and friends and family, essentially, if you're only operating as a limited partnership and using the accredited investor exemption. Now, if you want to allow a broader group of investors, you can then prepare an offering memorandum and allow eligible investors. So eligible investors are individuals making 75,000 per year or 125 combined with a spouse, or have $400,000 in net financial assets or $1 million in net worth. So these individuals are then able to invest using the offering memorandum exemption. Now, through the offering memorandum exemption, you can also allow what we call retail investors, or which would be non-eligible investors. And so these would be individuals who don't meet any of the other qualifications, but are still over the age of 18. And so they would be limited to only $10,000 per year into all private funds using the offering memorandum exemption. So they can only invest smaller amounts. The eligible investors that we mentioned, they can invest with advice from an EMD up to $100,000 per year into all offering memorandum-based investments, and accredited investors don't have any fixed limit set by the regulators. So if you want to expand the type of people who can access your fund, you'll need to use this sort of different exemptions and different additional paperwork. And even if you're able to go out to the general public like you can using the offering memorandum exemption, there will still be limits on the maximum amount that you can take from people. You can't take $50,000 from someone who is a retail investor or a non-eligible investor, because since that individual doesn't have 75,000 in annual income or $400,000 in net financial assets, $50,000 would represent an extremely large percentage of that person's total financial net worth. And so putting that all into one single private higher risk investment is essentially something the government is unwilling to allow.
And you talked about this a little bit before, but maybe quickly you can run over what are the exemptions and what are the documents required.
Certainly. So the sort of simplest exemption to access, but the one that's the most restrictive with regards to investors, is going to be the accredited investor exemption. So this exemption allows you to raise from accredited investors only. You can basically raise from these individuals without a ton of additional paperwork. The one document that you would need to have, of course, is the actual subscription agreement to allow them to actually buy the units. Equivesto has a template subscription agreement depending on your situation that you might be able to use. And you're going to want to prepare a term sheet that summarizes the terms of the investment and potential returns to investors. Again, in certain scenarios, Equivesto can help draft one of those for you. Another exemption that you would be able to use is the Friends, Family, and Close Business Associates exemption. So this allows you to raise from immediate friends, family, and close business associates. There are specific restrictions around this, and people will have to fill out a bunch of additional paperwork in order to participate in this way. So this is not sort of a loophole where, oh, these are my 700 closest friends type situation. You really have to define the details of your relationship with this person, and simply being members of a joint organization like a religious institution or a social club does not qualify them as a close friend. Another exemption that you might make use of is the private issuer exemption. So the private issuer exemption is essentially the accredited investor exemption and the friends and family and close business associates exemption combined, where you don't have to do any filings with the regulators when you have less than 50 shareholders. So with the accredited investor exemption and the friends and family exemption, once you basically gather all the capital and do a closing, you have to file a one-time filing called a report of exempt distribution. It's not extremely onerous. It takes 1 or 2 hours of your legal counsel's time, and the regulator in each province will charge you, $200 or $300. So it's not a big deal to file this report. But if you have less than 50 shareholders, you're able to take friends and family and accredited investors in directly yourself through the private issuer exemption without having to do any filings. Once you have more than 50 shareholders, you can still take accredited investors and friends and family without you don't have to go public, you don't have to do audited statements, you don't have to do statements of any kind. You just have to file that one-time report after you raise. Now, the next exemption that you might be able to make use of would be the offering memorandum exemption. So this really expands the number of investors who can participate. So the general public living in Canada can now participate into your investment, but there's much more paperwork, legal fees, and ongoing reporting required with the offering memorandum exemption. But you can, continue to raise larger amounts of money using that. Now, for funds, you can't use there's another exemption called the 45-110 startup crowdfunding exemption, but essentially the equity crowdfunding exemption. For a fund, you can't use this exemption. But if you're using a special purpose vehicle to invest in a single asset, so a single company or a single property or a single development, you can use this exemption to raise from the general public, but there's additional sort of limitations and requirements, but it's not as onerous as the offering memorandum exemption.
Okay. On the internal side, what goes into like managing a fund?
So in terms of managing your fund, so let's say you've set up your fund and people are investing in, you're going to be needing to do a closing to actually accept and take the money. So every time people are signing all the investment documents with the exempt market dealer and everything, all those kind of gather in a pile. The exempt market dealer is collecting the money, they're gathering all the signed documents. There is a moment where that actually flows to you as the fund. You get the money and you can start spending it. That's called a closing. So when the closing takes place, you're getting the money, you're getting all the documents from the exempt market dealer. You're going to have to file that one-time report of exempt distribution. You're also going to have to internally actually issue the units. So you're going to complete some documentation to actually give internally all the units to these new investors and record them as being actual unit holders in your fund. So once you've done the closing, you now have all this money. Fantastic. What do? Hopefully, you've been picking some different investments that you want to participate in. So you can actually start making those investments and putting those dollars into the underlying investments. You're going to spend more time looking for more investments as more money comes in, and you'll be looking to put money into those different investments. Now, depending on your strategy, the investments you've made will require most likely some level of support or management or upkeep or advice. There's a whole range depending on what you're actually investing in. But you're going to need to be managing all those different investments that you've made, making sure that they're going well, proceeding as planned and expected. You're going to have to do some internal record keeping and accounting to make sure you know, okay, what money is coming in, what money is going out, what percent of the money is coming in is being held back as a management fee. Do we have a management fee? Is that allowed? You need to make sure you're following the rules you set for yourself in your limited partnership agreement around how you can actually use client funds and what can they be used for. In terms of the management and everything like that on an annual basis, you're going to need to be preparing the annual filings for the fund itself, the limited partnership, and for your numbered company. If you have a trust, there'll be a filing for the trust as well. And you're going to have to prepare individual tax documents for every underlying limited partner. These are called T5013s. So you'll have to prepare those for each one, sort of distributing the income or losses of the underlying limited partnership to all of the either limited partners or general partner as per the rules of your fund. So essentially, you're going to sort of do this ongoing work for the number of years of the fund. So you'll be managing the actual investments. You'll be doing some reporting and sort of reconciliation, accounting of the money coming in, the money going out, what you're investing in, and then you're going to be providing updates to your investors. We recommend quarterly updates. So you're going to be sending emails, potentially holding calls, providing updates to the investors on what's going on with the investments. And then if your fund is a limited time fund, so let's say the fund is only 5 years long, near the end of the 5 years, hopefully all of your investments start coming good. So now you're going to start getting money back in as the investments exit. So you'll be collecting all these funds. Once they're all exited, then you'll be preparing to actually pay out to the investors and shut the fund down. So at this time, you'll be working with your accountants and your lawyers to make sure you're preparing all the right filings and doing the right paperwork. You're going to be distributing those returns to the investors. And then once all those have been done, following the steps and rules outlined in your limited partnership agreement, you could actually then shut down and disband the limited partnership and close out your fund. Of course, taking your management fee and success fee and sort of whatever those are based on the limited partnership agreement. If you're running an evergreen fund, then you will have different ways that you calculate potentially the returns for management. So you'll have the sort of management fees that you're charging every year, but there might be some additional fee or bonus depending on other areas. So again, you'll work with your accountants or lawyers to make sure that those are being calculated correctly and you're paying out those distributions to investors. Most evergreen funds are going to be paying out distributions on an annual or quarterly basis. So there's going to be even more accounting and paperwork involved in processing all of those, especially if you also have investors through TFSAs, RRSPs, or other registered accounts. And then if you're evergreen, instead of having a big closing at the end and where you sort of disband the fund and release all of the returns back to the investors, you're going to have distributions, which we sort of talked about already, but you're also going to have redemptions. And so redemptions is the moment when the unit holder sells their units back to the fund. So you're going to need to be keeping track of how long people have been in the fund, what are the different redemption fees, and when can people make redemptions, how do you process those redemptions, but then also, most critically, how do you make sure you have enough capital available to actually pay those redemptions? So smaller funds will have larger redemption fees and sort of plan their cash flows around specific moments that they want to sort of funnel investors into. Much larger funds will actually use a redemption line. So a redemption line is essentially a revolving line of credit that is issued by one of the larger banks. And this is a rather costly line of credit, but essentially it lets you borrow from the bank to pay redemptions, paying a rather high interest rate to buy yourself a little bit of time. So if you need to sell an asset to pay a redemption, you don't have to do that immediately. You can pay out the redemption, and then you can wait for the moment in the market where it's most advantageous for you to sell that asset to then repay the loan. So really depending on how complex you want to make your fund structure and the types of investments you want to make, there you can add more and more layers of complexity when it comes to actually managing your fund. But on the simplest, most baseline level, you've got your limited partnership and your general partnership. There's annual filings for both. There's annual tax forms for your limited partners, and you're just providing quarterly updates to the investors and managing the investments you're making until the fund closes down, and then you repay all the investors.
Awesome. And are there any other considerations or alternatives that I could look into, for example, like a SPV that we talked about before?
Yeah. So when you're looking at making investments and moving money as a fund, one of the things that you want to be thinking about is how are you actually trying to move these investors and have them participate in the investment? If you really want to be the person in charge, you want to pool the money and you want to be making multiple investments over time without having to go back to the investors each time you're making further investments, then you definitely need to be having a fund. But if you want the investors to be involved in the choice for each underlying investment, and you want to go back to the investors every time an underlying investment comes up, then it might be more effective not to set up a whole fund, but to set up individual special purpose vehicles for each underlying investment. And so essentially a special purpose vehicle is using the same structure as a fund. So it's that limited partnership, general partner sort of setup structure. But the benefit with using a special purpose vehicle is it's clear what the money is going into. It's not something called a blind pool. So it's not people giving a bunch of money to you and then you picking where it goes. Each investor sees the underlying investment, and the structure of the SPV makes it very clear that the money going into this special purpose vehicle, this limited partnership, is to go into that underlying investment at these clearly set terms. So this helps investors feel much more confident. They understand exactly where their money's going. It makes things much more transparent. Also, because it's into one single investment, it makes some of that paperwork a little bit easier. So those annual filings, if you're working with a company that specializes in SPVs like Equivesto, you could actually pay for a managed service. So Equivesto will take care of that annualized paperwork, included those T5013s on your behalf. So when you're looking at making the investments, you really need to decide, okay, are we going into investments kind of one at a time? And I'm just kind of gathering these people. And so maybe a special purpose vehicle makes more sense. Or is it really about me raising, 5, 10 million, and then me going out over the next 5 years and choosing investments, and people really want to give the money to me and then no longer be involved? And then in that situation, you would definitely want to set up a fund.
How are funds different in Canada than anywhere else?
So there's I'm not a lawyer and I'm not a tax specialist, so this is not legal or tax advice for sure. But one thing that is important to keep in mind is funds are typically set up as limited partnerships in Canada. And with the limited partnership structure in Canada, limited partnerships do not have to pay any income tax. They're what's called a flow-through vehicle. So essentially, the income or the losses every year are allocated to their limited partners. So if the fund makes, $10,000 and there's 10 limited partners, you would probably allocate $1,000 of that income to each of those 10 limited partners. And so that would flow straight through. And those limited partners would then have an additional $1,000 of their income tax. So what that does is it allows you to minimize the actual taxes you're paying on your investments. So the fund doesn't have to pay all these income taxes and then pass the money to the investors afterwards. So there's no double taxation. Now, what's important to keep in mind, and again, make sure to speak to your accountant or tax lawyer on this regard, but with a limited partnership in Canada, as soon as you have one member of the limited partnership who is not a Canadian resident, even just one, suddenly there is an automatic income tax that needs to be collected. So if you're raising a fund in Canada, and you have one limited partnership agreement, but you want to allow in a bunch of US investors, that could have serious tax implications on your fund, but also all of the other investors in your fund and their returns. And so if you're going to take investors from outside of Canada, you might want to set up a second limited partnership just for those external investors, or you might want to have them set up Canadian corporations and then invest into your fund through those Canadian corporations so that every entity in your main fund is a Canadian resident for tax purposes.
And where can I get started on setting up my fund?
If you're looking on getting your fund set up for the first time and you're looking to structure it in a rather simple and a straightforward way, you can work with us at Equivesto. We help set up limited partnership agreements, numbered general partners, and we have a templated limited partnership agreement that you can make use of. If you're looking to build something more complex and you want very specialized terms, then it would be best to speak to your own legal counsel, specifically a securities lawyer, to help you structure and set up your fund, especially if you're going to be looking to do a trust and involve the offering memorandum and all these additional pieces, then it would be best to seek your own legal counsel. We would be happy to make some introductions on a personal basis, depending on the direction that you want to take your fund. But if you're looking for a special purpose vehicle or something highly simple, that's something that Equivesto can potentially help you with in a sort of more automated, straightforward way.
All right, thank you, Alex. That wraps up funds. So we'll check back at the next co-founder chats. Thanks, everyone.
Thanks, everyone.